Before we begin, here's how to earn continuing professional education credit for attending this session. Gain valuable insights by attending the podcast, then complete the assessment test to download your certificate. To do this, follow these simple steps. Click on the link in your description to access the session. Create a free account and attend the podcast. After the podcast, take the assessment test and download your certificate. It's easy, and it's free. We highly recommend checking out our subscription. Let's get started.
And, for anyone who is tuning in and thinking, okay, I need to talk to my parents or my kids this week or whenever, if at all somebody had to have that thought, if there is one thing that someone can do this week or whenever they're listening to this podcast to prevent the future heartache, what would it be?
Other than, buying a copy of the Inheritance Playbook and reading it. No,
Yes.
I would say the exercise that, at least to me, even when I think about it and I'm in this world, it stops me in my tracks. And the exercise is this: you just got the call and your parents passed away. First of all, I'm sorry. Second of all, what on earth is your next step? Do you know where their will is? Do you know where their accounts are? Do you have any idea how to access their world and settle their estate? And if you got any pause or like, oh gosh, other than the hypothetical of they just passed, but if the thought of going into an empty house right now, and it's not empty, it's probably full of junk, but if that thought scared you at all, I hope that is the motivating factor that you need to start planning now. Because yeah, technically you don't need a will or trust until you die, but you don't know when that is, and neither do they. And so if I can just inspire people to have those conversations. Actually, there's a book called
Welcome everyone to another episode of your favorite podcast we're trying to figure out. I'm your host Saul, and today we are figuring out something that touches every single family at some point: inheritance. Not just what gets what, but how do we do it right so it doesn't lead to conflict, confusion, or courtrooms. With that, I want to welcome our guest today, Chad Holmes. Chad, welcome. It's a pleasure to have you.
Saul. Thank you so much for having me on today.
Absolutely. Now, to all our listeners, if you have any questions for Chad, please drop them in the comments on LinkedIn or YouTube. And if you're looking for CPE credits or want to join us for future CPE approved episodes on MyCPE1, head to mycpe.com/podcast. You can also listen on the go by downloading our MyCPE1 app, which is available on iOS and Android. Now, let's get back into the podcast. Chad, your book, The Inheritance Playbook, doesn't read like a textbook, and thank goodness for that. But before we get into the probate and the planning, let's start with you. Growing up with two CPA parents and helping your grandparents, how did that influence your thinking about money and legacy?
Right. Growing up with two CPAs, it's more exciting than it sounds. They're very fun, outgoing people, but I ended up going the CPA route, and it just came naturally to me. I love the accounting side of things, and I went into the audit world with one of the big four firms and realized something was missing. I just wasn't passionate about what I was doing, and I happened to be at my grandparents' house one day, and my grandfather was disabled, and so they had their financial advisor come to their house, and I thought that was really cool. And they let me listen in because they knew I was kind of interested in that world, and it kind of opened up my eyes as to what delivering personal financial advice to individual families, as opposed to helping billion-dollar corporations approve their balance sheets or things like that. And so I really got excited about that world. And once I finished up my this audit track and jumped over to the CFP world for financial planners, it was about 2016. I really started to get excited about working with individual families and understanding that tax side more than, the traditional CFPs that might have had a course or not. But I found that knowledge so crucial to being able to deliver financial advice. Because honestly, if you're giving financial advice but you don't think about the taxes, it's
Yes.
incomplete and you're really missing a variable right there. So it's a powerful knowledge set.
Well, the only thing inevitable in life is death and taxes, right?
Right.
But, so you got into financial planning and you have this specific focus on multi-generational wealth. Why such a focus? Why focus on multi-generational wealth?
I accidentally fell into it. So started my own business after working with a great firm in Texas for a few years. And trying to figure out what my niche was. Who was I going to serve? How do you differentiate from the mega firms that have billions of marketing dollars? Um, and I started thinking, well, who do I like serving? And I kind of liked a lot of people I was serving. And what I really liked was some of the first clients that I actually got was my parents and my grandparents. I'm like, I like serving my family, but you know what? You can't start a business like that. What I
Yeah.
realized what I liked doing when I was serving them is I was doing a different kind of planning. And it was because I had both generations together with the same advisor, I was able to think about long-term planning from a unique lens as opposed to, hey, let's minimize the taxes for every client. What if we step back and we minimize taxes for the bloodline? That looks very different for financial planning strategies when you're thinking about a longer term horizon. Let's if they're in different tax brackets, my grandparents and my parents, and different sets of income and different risk tolerances, but by understanding the variables with two different generations on the same book, okay, now things are different, and now I'm bringing value that other planners aren't doing. And
Yeah.
so I thought, you know what, multi-generational planning. We've got baby boomers getting older. I figured this was a huge market out there. We've got trillions of dollars to be passed down. What's being dubbed the great wealth transfer that's upon us over the next decade or two. I've seen
True.
estimates of like 70 or 80 trillion dollars. I mean, made up numbers is what it seems like. But money's being passed down whether we plan for it or not. And what I want to do is make sure it's done most efficiently with, planning for that legacy and maximizing wealth and minimizing taxes, minimizing probate, we should talk about in a little bit, but that's the unique perspective we're bringing here with this multi-generational planning.
Absolutely. And you have actually done something that a lot of people are still thinking about. You have written a book, and I'm sure it must have been a mammoth task in itself, and you must have thought about writing the book. But your writing in the book is very refreshingly human. You have incorporated this unique storytelling way of sharing it across. So was that an intentional idea that you had from the start, or was it something that you just learned as you went along?
It was very intentional. So once I realized I didn't want to write the book for CPAs or for attorneys, but I wanted it to be out for every American. Why? Because that's more people to buy it, right? You increase the audience when you kind of bring things down from a tax language level. And so
True.
I knew it had to be told in stories because otherwise this stuff can be very boring. And honestly, what we're really talking about is death and losing parents. And that's such a dark topic. So I try to make it refreshing and entertaining, and there's sarcasm and humor throughout. But the idea is to educate while entertain, just so you can keep flipping the pages. Because I do think that the value of the stories in here, they're like parables, like a family does this, oh, they learned a lesson, and here's what it cost them by not thinking ahead and by not knowing the rules. And in doing that, I'm hoping that more people, not just the tax professionals, not just the attorneys or CFPs even, but more people are able to finish the book and really save their family a tremendous amount of time, headache, money, all that.
Yeah, absolutely. I mean, I have to say, one of the most powerful things in your book is how approachable it is. Like you rightly said, when you put that storytelling element into it, it reaches out to it resonates to a larger audience, and it almost feels like a conversation that you would have around a dinner table, which is exactly what estate planning should be actually.
Hmm.
You want to have that. So, but so let's get into the weeds a little bit. We often hear people say, I'll deal with estate planning later. And that's something that you keep on hearing until it's too late. So, why are probate and taxes such landmines for families who delay planning?
Do you want to earn CPE credit? Take this course of MyCPE 1 to earn free credit. Click the link in the description to get started.
So by delaying planning, we're letting the default state rules fall upon our family. And so what probate is, it's the legal process that, validates your will or starts the will, if you died intestate, which means without a will, it
Mhm.
starts that process of settling your estate. And it's done through courts. And as you can imagine, it's very expensive and it's
Yep.
very time consuming. It takes 6 months in some states at a minimum. Sometimes it can be years if there's complexities going on, or if there's families arguing about things. And so by planning ahead and communicating, you're removing surprises. We're able to think through things. And there's what a lot of people don't realize is there's two different versions of probate. There's the full probate, and that can be the nightmare one that you hear about a lot. But every
Mhm.
state has its rules for called summary probate, and that's like the fast track, short, let's go, let's very efficient probate that can be settled much faster because you're not getting your inheritance from that probate estate until probate is settled. And so for a lot of families, they need this to go faster. And so summary probate, for example, I live in Alabama and I think it's like $36,000. Your estate needs to be, your probate estate needs to be below that amount before, in order to get that summary probate, the fast version. And you may think $36,000, that's a very small amount. Everybody's going to be over that. But that's not true because there's your total estate and there's probate estate.
Okay.
And so your IRA that has a beneficiary on it, that's not going to probate. That's outside of probate. Your 401k and anything with beneficiaries will go outside of probate. And so by doing it strategically, you can get your family's um, probate estate down below your state's minimum. Some states it's 50,000, 100,000. There's a wide range of how states work with this, but let's say you've got a brokerage account. Normally that goes to your probate estate, but by adding what's called transfer on death (TOD) designation to that, you put a beneficiary on that after-tax account, your brokerage investment account, and now that free little quick, super fast form that you filled out avoided probate. It goes straight to the beneficiaries, and now just really simple, easy things like that can be done and drastically reduce the value of your probate estate to get you down to your state's summary probate limit so that you can do it the easy way. And that is so valuable. You also asked about taxes. Obviously taxes are huge when it comes to when your wealth transfer, and not just for estate taxes. Right now the estate tax limit is close to $14 million per person. And so we're talking to almost no one when I'm using those numbers. But there's other taxes to consider as well. Taxes on your IRA money. So, your aging parents have an IRA. When they pull the money out, it's ordinary income. When you inherit it and you pull it out, it's ordinary income. Guess what? There's a planning opportunity there if your parents are in the 12% tax bracket because all they're living on is Social Security and a pension and RMDs, and you're in the, still working and in the 32% bracket. Okay, well, let's do a little more advanced distributions out of their IRA. Take them to the top of the 12% tax bracket so that you're not inheriting and paying at 32%. Because guess what?
Yes.
We just created a 20% savings. That's not a hypothetical, like that's a real tax differential in savings. And just by planning, thinking about it from a two-generational lens really gives you ideas on how to maximize the legacy and minimize taxes. So it can be really powerful to plan ahead.
Absolutely. When I'm listening to you, it there's a company in India. It's one of the oldest companies. It's a Life Insurance Corporation of India. The slogan of the company is uh, "With you in life and with you after life," because they've got their plans that way. But we're not here to
Yeah.
talk about LIC. But it is talking about, it is also giving that vision. You got to plan ahead beyond just your current generation, multi-generational. And in your book, you have covered a lot of anecdotes. You have mentioned about cases where families have made decisions that unintentionally increase their tax bill. So could it be possible for you to share one of those with us?
Yeah. So there's a lot, the book's really
Yeah.
about a bunch of different stories. And so one idea we just shared was if you pull money out of the IRA a little faster, or making Roth conversions is another one in that same chapter. But in the you talk about risk, that's different. So a lot of times we think the younger you are as an investor, the more aggressive you can be in your portfolio.
Mm-hmm.
And the older we get, we can probably pull back some of that risk, a little more conservative, because we understand we're going to get close to retirement and then we're going to start pulling down on that money. And once we're in that retirement, we want to be kind of conservative, because a market crash in retirement can really hurt an investment portfolio if you're also having to sell out while it's down. Um, and so the multi-generational planning perspective says, okay, yeah, that does make sense, but let's challenge that for a moment.
Mm-hmm.
If your aging parents have a large nest egg and they're living just fine on Social Security, pension, RMDs, and they've got a long-term care policy in place, which means if the worst were to happen, I'll say not the worst, second worst were to happen, and they would have to go to long-term care policy, there's assets to cover that as well. Um, so really, we're pretty confident that there's this large nest egg that they're not even going to touch.
Mm-hmm.
And so if we think about their risk tolerance, which, there's two angles about understanding someone's risk tolerance. It's time horizon. How
Mm-hmm.
long do I have until I need to touch this money? And the second element is just your stomach. Like, can you be risky enough and stomach a market crash and not panic and sell? If you can get through a market crash without panic selling, then you can probably be at that risk level.
Yeah.
And so understanding those two elements. So when we think about our aging parents and this large nest egg that they're not going to touch, it doesn't make sense to have that at the risk level of the aging parent with a short timeline, because it's not meant for them. It's meant for the next generation, which has probably decades longer of a time horizon and therefore automatically should have a higher risk level associated with it. And so, if you've got parents in their late 80s and they've got this money, some or all of it should be mirrored with your 50s or 60s, whatever, risk tolerance. It should be more aggressive because it has time to crash and rebound multiple times throughout your life. And so, by doing that kind of planning and going against the norms, what we're doing is creating, uh, higher expected rate of return, right? Because more risk does not mean more return. But over time, we expect that return to be higher. And when you have a little bit higher return each year for decades, that compounds into what our minds can't comprehend.
Yes.
Decades of compounding growth can be just unbelievable sometimes. And so that approach to planning that challenges the norms is one other way to really think about how are we challenging, how are we creating value here with the families?
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.
Well, it's phenomenal the way you put it out. You know, you're probably doing this day in, day out. That's why, it's easier for you to say it out. But to all our listeners, it's still a masterclass in itself, because there's so many things that you put out here. So I want to get a little bit more real about everything that you talked about. In fact, when we talk about, people don't really talk about this. Fidelity survey that I read, it said that 67% of adult children and parents, they haven't really talked about asset plans at all. And and that's actually a setup for chaos because you don't want to go through that probate and all that, and that could be another problem in itself. But your book, it does a great job of making estate planning feel like it's doable. You're not just asking people to be tax experts, but you're giving them the tools. So, if you were to talk about it, can you unpack one of your core strategies, like, I don't know, account tilling or Roth conversions?
Yeah, account titling is one of the key components here of getting your estate down to that summary probate level.
Mm-hmm.
Instead of just having an individual investment account, if we change that to a designated beneficiary, that TOD we mentioned, um, if we make sure there's beneficiaries on everything, or if we, some states allow what's called a ladybird deed on your home. And what's valuable about having your home not have to go through probate, because here's one of the big problems, and this is common, and I've actually seen this more times than I care. Um, Families gift their home to their children so that they avoid probate. Because what am I talking about this whole time? Probate's terrible and we want to avoid it. Yes, but not if it's going to create tens of thousands of dollars in unnecessary taxes. And so what I mean by that is, let's say your parents bought a home for $100,000 30 years ago.
Yeah.
Now that home is worth just a tremendous amount of money.
True.
Um, and let's call it 500,000. So there's a $400,000 gain. If the parent dies, um, and owns that house, and then you inherit it, the house would go through probate, but it would get what's called a step up in basis, where although your parents' basis was 100,000 plus any improvements they put into it, let's just call it 100,000. Uh, you get a step up in basis so that the value of the home is what it was valued on the date of their death. And that's now your new basis. So now you inherit a home worth 500,000 and the basis is 500,000. You can sell it. That's $0 in capital gains.
Yeah.
What families try to do to be smart, and unknowingly mess up is they gift their children the home while they're still alive. And they say, now you don't have to go through probate. Okay, that's cool to avoid probate, but guess what? Now the children own a home, it's in their name, and so the parent's death does nothing to change the basis. Now they own
Correct.
a home worth 500,000 and the basis is that of the giftor, which is 100,000. So if they sell it, they have a $400,000 capital gain. So
True.
just by trying to be smart but doing it the wrong way, you've
Yeah.
created tens of thousands of dollars in capital gains taxes. And it's one of those things that, yeah, you got a tip from your neighbor, your barber, your church friend, or someone else in the nursing home, and it was you heard a partial truth, and they heard it from someone else, and without working with a professional that really understands the ins and outs of these nuances, you could be going in what you think is the proactive manner, but you're missing a key feature here. Yeah, probate's not fun, but let's not pay tens of thousands of dollars to avoid it. If
Yeah.
there's better ways to do that, we could deed the house, or like I mentioned, the
Yeah.
ladybird deed, where it stays in the owner's name and it goes to a beneficiary at death, and they receive a step up in basis, and it avoids probate. So there's certain states that allow incredible opportunities like that. I believe Texas is one of them, but anyway, or put the home in a revocable living trust, and that way children will get the step up in basis, you avoid probate, all that stuff. So there are ways to avoid some of these, scary situations, but do it the right way and understand the consequences of not doing it the right way is pretty powerful.
You mentioned trust, and that is something that I wanted to talk to you about, because whenever, if this was a misconception even I had, because a lot of people think that trusts are only for millionaires or billionaires
Mhm.
or whatever you want to call
Yep.
them. Right? But what's your take on that? When does a trust make sense, and when is it an overkill?
Yeah, so that is such a misnomer. People thinking that trusts are for only the mega wealthy. And And I get why. I mean, that's kind of you hear about trust fund kid or something like that. Like
Yes.
the association with the name is just for the ultra wealthy. But if you have children that are minors, if you have children that are married, um, I mean, look at the divorce rates. If your children inherit uh, your legacy and they get a divorce, and if it just came from the will, guess what? That the spouse, your ex son-in-law, ex daughter-in-law, is entitled to half of that if they just own it outright. It's marital assets at that point. Um, and so, I mean, if you have a vacation home in a different state, you want to have a trust because you have to settle probate in every estate where you have property, unless it's in a trust. If you can just put everything in the trust, then you only have to do the probate that one time.
Right.
Um, which is an incredible time-saving piece of knowledge there. Um, so yeah, special needs. If you have a child with special needs, they may be entitled to government benefits, but
Right.
not if they're a rich person with special needs. And so by putting their inheritance in a trust, um, it's not in their name, and therefore they can still get the government benefits. Whilst, there's ways you phrase the special needs trust to make sure that they still have access to it. Let's see. There are a lot of different ways, and none of that really has to do with level of wealth. That's just
Yeah.
certain situations. You want your children to be taken care of. You don't want a 10-year-old coming into millions of dollars. That's not possible. That you need some sort of setup.
Correct.
And so there's just when is it overkill? I'll say you are 22 years old, you're not married, and you don't have much of anything.
Right.
If you're not married and you don't have a lot of assets, there could still be an argument because let's say you're, God forbid, in a coma or something, incapacitated. You want somebody to be able to handle your affairs, pay your bills, all that stuff. That's where a trust can be helpful. And it has nothing to do with the amount of money you have. It's just giving permission to somebody so that they don't have to go to courts and argue all this stuff while you're knocked out. And it really smooths the process, and it's truly the best gift you can give your loved ones, so that they're not hunting for information and trying to figure things out while your legacy is being destroyed with costs and things like that, unnecessary taxes. Um, it is such a nice gift to leave your loved ones.
Absolutely. And I think, this is where a lot of people freeze up. They are overwhelmed when it comes to estate planning. But like you said, it's often just those one or two small changes that can really make a big difference. Like you broke it down, about a trust and everything, the risk profile and everything. I really like that, because the next part that I'm about to talk about, it's something that also hit me emotionally, because you're not just talking about dollars, you're also talking about dignity, you know and there's this thing where you talk, where I wanted to know, why is it important to include your parents' values and voice in this book, not just the financial pieces?
So, when I was writing this book and coming out with all these strategies, and I'm telling, friends or family about it, it, it sounded to me, or when I would hear some feedback, I would think that others were thinking of me, how do I, get the most out of my parents? And that's not the angle we're going for. We're not taking advantage of parents. That's not it at all. It's honoring that legacy by not wasting it, by being proactive, by being clear communicators, and being honest with intentions. And so it was really important to me to offset that. Nobody came out and accused me of it, but in my head, I was paranoid that people are going to think that this is just a super greedy book, because it's not about that. It's about saving taxes. You know, and so it's about their legacy. And a lot of people that read this book, which I think now sold over 7,000 copies, and I don't do marketing, like I'm terrible at advertising and stuff. So for it to have done 7,000 copies, I'm super happy with. But a lot of families reading this book and making the comments on the Amazon review page um, talk about how they wish they had had this earlier because their parents either now has Alzheimer's, dementia, some kind, or otherwise incapacitated, and they cannot communicate with them anymore, not in a productive way. And so, for those reading the book that or listening to this podcast that can still communicate with their parents, and you're lucky enough to be able to do so, be honest with them. Say, hey, I recognize there's something you're leaving behind here. What do you have input on that? Like, I've never received a gift of that size ever before. This is going to be life changing for me and my kids. Um, do you have input on what you want me to do with it? Maybe there was a vacation that was super important for them for you to redo that they did with you when you were little, or maybe there's a charity that you want to make sure is mentioned, or like, hey, or maybe they have no opinion at all. There's so many ways it could go, but getting their input probably helps you feel empowered when you do finally receive that legacy. And as sad as it is to lose that loved one, um, at least that gift left behind, you feel like you have purpose with it. And, hey, I'm going to do what was intended. Um, and so having that conversation can be healthy. And also, money topics, especially in America, money's very taboo. We don't talk about it. There's shame with money. There's fear with money. Is my child going to take advantage of me if I disclose to them all my assets right now? There's all sorts of emotions, and we kind of hide money topics all the time. And in doing so, the IRS wins because they collect taxes on inefficient planning. Um, and I'm trying to break that. I really want families to open up, have these conversations, discuss, hey, here's what I've got and here's where it is, because I think understanding where things are, what there is, and how to plan for that as a family with an open, honest conversation with intent. Um, that's where a lot of value comes from, not just financial value, but the emotional value of peace of mind, being able to plan and understand what's going on. And um, your parents aren't wanting to create this massive time-consuming homework project for you when they leave. That's not their intent. They just maybe haven't thought about it, or they did think about it when they created estate documents 20 years ago, and they think everything's set, but so much has changed, so much needs to be updated. For example, do you know your parents' phone password or email password? You're going to need to get that to close down accounts and all that stuff. There's so much that we don't think about just writing estate documents. My child gets everything. Okay, that's not helpful at all. Where do they get it? What's out there? Is there a safe deposit box somewhere? Is there a life insurance policy? Parents, when they pass, life insurance companies don't call you and say, hey, look out for this check in the mail coming for you. You have to notify them. You have to say, here, I'm the beneficiary. Here's the policy number. Here's my address. You know, you have to know where to look and who to contact, and turn off the phone bills and the electricity, and all that with the house. There's just a tremendous amount of stuff that needs to be done, and it's not just about my child gets everything, I signed the end. Um, it's a long, lengthy conversations we need to have. Or there's binders out there now. There's a company called Next of Kin, or Knockbox, NOK box, and it stands for Next of Kin. And
Mhm.
they're one of many, but you can get this box of, it's file folders and documents, and places for you to write your passwords, and they can be either fireproof boxes or digital, or whatever. But it's you got to leave a roadmap behind for the children and the next generation. And um, people listening to this, I hope not only are you able to have a conversation with generation above, but also think about, you may be leaving Earth
Yes.
earlier than you planned
Yeah.
too, and you
Yeah.
need to be having these conversations with your family, and leaving a very easy to follow, step by step place of where things are. And of course, there needs to be someone you trust in your life to do that. And hopefully everyone has that. But sometimes, if all somebody has is a degenerate kid, and it's like, I can't just, I want to leave them stuff, but they can't be the executor of my estate.
Yes.
There's ways to go around that. And you mentioned uh, who else needs a trust? If your child is a spendthrift or a gambler, or on the verge of divorce, or whatever it is, but there's ways to protect the money from them getting it all at once. Um, and so there's those things to consider. And so when we have these conversations with the parents, I also want to emphasize that you need to think about it from their perspective too. And like I mentioned earlier,
Yes.
the shame. They may be ashamed at how little they have, even though it may be a lot, or maybe they're ashamed at how disorganized they are, or how they don't know where everything is, and that may be embarrassing. Um, and when that's the case, you really need to come with gentle patience, kindness, understanding, all that, because this is for many families that are in their 80s right now. They have more money in their accounts than they ever thought they'd have. This is, growing up around the Depression, they had no dreams of ever having $100,000, and now they've got millions. And when that's the case, it's hard to comprehend what that could mean, what that could do to the family. Gifting strategies is another big topic I talk about in the book. But if if we can have these conversations while they still have mental capacity, and keep going back to value, the value you can pass on to the generation is so powerful.
Chad, as you were saying, I'm sure I was going through a journey myself in the back of my head as you were saying it. And I'm certain that a lot of our listeners, as they're listening into it, they would be going through a journey themselves. For those who have had the talk, for those who have not yet thought about it, for those who are in that position that they are going to be having, they're in that position that they will eventually have to plan for it for their kids. They're going to be going through that journey. And I could see that you are really passionate about this. You really had a strong emotion behind it. So if possible, is there any personal memory or a moment from your family that really drove this point home?
Yeah, before I started focusing on the multi-generational planning, it would just be me serving both my grandparents and my parents in the financial planning software that I've got. And I'm, looking at my parents' plan, and we're solving for X dollars of inheritance at some certain date in the future. Of course, it's sarcastic. We have no idea when or how much. Um, and then I'm looking at my grandparents' financial plan, and we're solving for certain things, and there was a legacy amount that was projected to be left behind, and there's just a major disconnect between these plans, and I finally just it clicked on me, like, the software planning does not solve for long-term generational perspective, and because there's just too many unknown variables, and it gets unbelievable, how wide the projection can get when you consider all these variables. And so I started, not literally pen to paper, but really just in Excel. Um, let's step back and think about, what are we really trying to do here, and what's the ultimate goal? And we start making moves in one direction that's, we know is the right direction. How much is it the right direction to be decided in the future? But when we were able to step back and just kind of think, okay, now we're planning differently from a different lens. And we did change the risk in my grandparents' portfolios because it needed to match that of the next generation, because family's blessed enough that there's expected to be some inheritance. And we did change titling, and we did do advanced IRA distributions. My mom's mom, we've completely pulled out all of her IRA distributions, so that the IRA is gone. All that's left is after tax money that will have a step up in basis. And we pulled that out at a very low tax bracket. My dad's side, there's still some IRA money left, but we're pulling out more than the RMD each year. That's the required minimum distribution. So every year, once you hit a certain age, you have to pull a certain amount, percentage out of your IRA. It's usually about 4%. It changes every year, but um, it, instead of just doing that minimum amount, we would do whatever amount made sense up to, 10 or 12% bracket, because that's pretty low, cheap money, really. So that next generation, my parents and aunts and uncles, are not inheriting that stuff, and paying their tax rate, which is higher.
Yeah.
Um, so that was really the first time that I thought about that strategy of, because if I was just serving my grandparents, telling them, hey, you need to pay more in taxes now is not a good service line. That doesn't need to be your tagline. But guess what? It makes total sense when you look at the bloodline, the total long term, where are these dollars lasting to? And so, yeah, I made my grandparents pay more in taxes. And guess what? Their legacy is going to be bigger because of it. And their total taxes paid from that legacy is smaller, because otherwise that would be spent at my parents' rate, or, things like that. And so those were the realizations that I had. And I thought, and we had a baby a couple years ago, in 2023, and I didn't want to take on any more clients because I knew I'm the stay-at-home dad, and I'm working part-time, and nothing's predictable with a new baby. And so I wanted to be productive with my time, so I started writing, these little blogs, that I was just going to publish every few weeks, once the baby got here. And then I'm telling my parents about this blog, and they're like, "Oh yeah, we love that you did all that with us, but this doesn't sound like blogs. This should be a book." And so I started thinking about this. This should be a book. You know what? Let's do that. And so, I've never written a book before, but tried to figure it out. Got an editor, and the editor I chose was someone who was almost, zero educated in finance and taxes and stuff, because I wanted somebody to tell me, write in big letters, what are you talking about here, if I got too into the weeds. Um, and she did a great job of that. And she kept pulling me, because sometimes I get too technical. I really try to work on it, and speak in language that everyone knows. And I especially wanted the book to be that way. And she did a great job of making sure that happened. And so, wrote the book, came out, and, actually during the year that I wrote the book, my granddad passed away. And so it was, he's kind of, I mentioned that in the, acknowledgments, and, family and stuff, but, just a lot has gone into this book from my own family, and a lot has been from clients I've served over the past decade, of things that they come and tell me, and I'm like, what do you mean? Your mom gifted you the house. Like, why didn't you tell me that? We would have structured that totally differently. And now you pay all these taxes. We got to pull these out. In order for you to pay those taxes, we have to sell some of your investments, and you have to pay capital gains on that. So now we're, paying taxes with taxes, and I mean, getting taxed on the taxes. And, it's just, without that stepping back and talking with the professional, people, it's a dangerous world. It's not designed to be efficient. It's designed for the IRS to capture as much taxes as possible from families who weren't aware of the rules. And so.
All right. I mean, this is interesting, I mean, and you have rightly talked about this podcast, and I firmly believe that, legacy planning, it isn't just about dying, right? It's about living. It's about living on purpose, right? And I guess, and that's something that your book is really capturing. So, I think your efforts are commendable. And, for anyone who is tuning in and thinking, okay, I need to talk to my parents or my kids this week or whenever, if at all somebody had to have that thought, if there is one thing that someone can do this week or whenever they're listening to this podcast to prevent the future heartache, heartache, what would it be?
Other than, buying a copy of the Inheritance Playbook and reading it, um, no,
Yes.
I would say the exercise that, at least to me, even when I think about it and I'm in this world, it stops me in my tracks. And the exercise is this: you just got the call, and your parents passed away. First of all, I'm sorry. Second of all, what on earth is your next step? Do you know where their will is? Do you know where their accounts are? Do you have any idea how to access their world and settle their estate? Um, and if you got any pause or like, oh gosh, other than the hypothetical of they just passed, but if the thought of going into an empty house right now, and it's not empty, it's probably full of junk, but um, if that thought scared you at all, I hope that is the motivating factor that you need to start planning now. Because, yeah, technically you don't need a will or a trust until you die. Um, but you don't know when that is, and neither do
Yes.
they. Um, and so if I can just inspire people to have those conversations, actually, there's a book called Mom and Dad, We Need to Talk by Cameron Huddleston. And it's about having those hard conversations with your parents. My book's more about the financial planning and tax planning side of things. Hers is about how do you phrase this conversation to a parent who is stubborn or ashamed or any number of personality traits, and it breaks it down to really good conversational hacks of getting them to open up and share, and so that you can have this difficult conversation. Hers is more the I guess the psychological side of that conversation, to get them to trust you and see that you're not trying to take advantage of them. You're trying to honor that legacy by not squandering it away on unnecessary taxes. And I stress the word unnecessary because taxes need to be paid, and I believe in taxes, but not more than we owe, right? Let's pay the government what they need to keep us safe and all that, but not more than we owe. And so with strategic planning, you know, even things like charitable gifts can be so much more meaningful when done from a planning perspective. There's I had a family uh, 5 or 6 years ago. They wrote in their will. Um, that they want $50,000 to go to their church and the rest to go to their kids. I'm like, wow, that's super nice. I thought about it and I was like, okay, there's no charitable deduction from your estate because your estate is not worth $10 million dollars or whatever it was at the time. There's no charitable deduction. So I did have them change their will, which the lawyer thankfully did it. I think because it was within 30 days, he just changed a little bit, and I don't think he charged them anything. At least they didn't tell me. But they changed it to children gets everything, and their son, who's kind of the closest one and lives, and he kind of helps them with a lot of stuff. He, it's his. The will says we recommend or wish, can't remember the exact phrasing, him to make a $50,000 donation to our church. And he was a member of that church too, because he lived locally and they'd all gone there for decades. But now the son gets that inheritance. And yes, it was factored in with the breakout of everybody else, but he got to make that $50,000 donation to the church. He hasn't yet, they're still alive. But sorry, I'm all over with this story. When they pass, he'll make it, and he's going to get a $50,000 itemized tax deduction. So now, just by changing a couple words, the church gets the same, everything happens, but all of a sudden we've created a huge offsetting tax deduction. I mean that's a tremendous amount to save on taxes, especially with their tax rate. And so that kind of planning, and then there's, if you're selling stocks every month to give to your church, you're paying capital gains on those stocks, and that's not the best way to do it. What you could do instead is gift the appreciated stock directly to the church. And therefore you avoid paying capital gains and you get the itemized deduction. Or once you hit a certain age, you can do the qualified charitable distributions, the QCD, and that's giving directly from your IRA to the church. That counts towards your required minimum distribution, and you don't have to pay ordinary income tax on it. So now we're lowering your ordinary income IRA and giving to the church, and counting against the RMD. You don't get the itemized tax deduction when you do that, but that's the offsetting benefits there. It still makes sense. And then the donor advised fund approach where you can give a lot in 1 year with just, appreciated assets. There's so many ways to give that's better than just cash to your, any charity each week or month, year, whatever. But those strategies can be powerful for families wanting to figure out how to give and make their legacies last longer in different ways.
Well, this is really insightful, and I love that. It's not just about making it perfect; it's about getting started. And I guess that's where Formula Wealth comes in. So tell us a little bit about Formula Wealth. How are you helping families put this plan into action?
So when I started my firm, 2020, I didn't know I wanted to do all this generational stuff. Once I decided that, though, I wanted to figure out a way because it seems oddly self-serving if I'm like, um, hey, I need you and your parents to come on as clients. And because traditionally in the wealth management world, financial planning world, you get paid a percentage based on the assets, and standard industry is about 1% is what you charge. And so if I was like, hey, I need you and your parents or you and your kids to come on, that seems oddly self-serving. And I didn't want to create roadblocks in bringing families over because I knew and still know that there's so much value to be had with having both generations with the same financial planner. And so I wanted to avoid that conflict of interest. And so I just said, you know what? I'm going to create a new fee structure. And I had to go through the state of Alabama. They did. We had a lot of back and forth about this unique fee structure because they're just used to the 1% of assets kind of thing. Um, but I'm doing a flat fee for families, and because there's a lot of complexity involved, I do require a minimum asset level right now, which is at $2 million. So as long as there's $2 million between both generations, and the younger generation has power of attorney over the older generation, one flat fee for the entire family. So if Gen 1 is a million and Gen 2 is a million, great. It's a flat $20,000, which is 1%. If they both have 5 million, it's the flat $20,000. So I wanted to practice what I preach and realize, you know what, I'm bringing the value to both families, and it's not going to cost you a dime more to bring your parents on. It's going to save you a tremendous amount more, though. And so at most, I'm charging 1%. And for families with, millions above that, it's well below industry average. So, but I work out of my house, and I have very little overhead. So I'm able to be just as profitable as the big guys when I'm doing it like this. And so, it's a good business model, and it's fun, and clients and their family, kids are like, wow, this is different
Yeah.
than what we've heard before. And it's not just stock picking, which I think so many financial advisors get categorized. Oh, what stock should I pick today? It's like, I don't know. That's not what I do. It's marrying taxes and estate and investments and insurance and
Wow.
retirement and cash flow and gifting and all that. It's marrying all that together with that lens, stepping back at two generations and realizing, okay, now we're going to start making steps, and now you're going to start seeing value compound with that lens.
Wow. Interesting. That's really interesting. Well, we started with a good note, and we had a really beautiful journey, and I'm sure all of our listeners who are listening to this podcast, they will have a lot more to take back. They have a very beautiful exercise that you shared with all of our viewers, so thank you for sharing that. I think
Yeah,
it's a
sorry,
very
sorry if that makes anyone sad, but that's what we're dealing with
no,
here.
I think it's a very powerful exercise, and I think everybody should do it. Better now than getting late, right? Now, but before I let you go, I would like to do a quick rapid fire round, but then I'll just say what comes to your mind. Short answers. If you don't know the answer, like I don't know, that's okay. All right. I'm just gonna ask five small questions. Number one, what's the most underrated estate planning tool?
Underrated, I'd say durable power of attorney.
Okay. Okay, what's the most overrated estate planning tool?
The lawyer.
All right, I like it. All right, one mistake you'll never make in your own estate plan.
Um, Keeping it private. I'm not doing that. I
All
don't.
right.
I want to communicate with the family, and that's happening. And it is very clear to my family what's going on with me, even though it, I wish I had, more money and wish I had less mistakes, and it doesn't matter. They need to know so that there's no mystery.
Perfect. Two more to go. And this is going to be really fun. Best time to start the conversation, before dinner or after?
Ooh. So, so for me, dreading a conversation, I'm not going to be able to eat dinner if I'm dreading the conversation. But at the same time, if it's beforehand and it goes badly, then you're uninvited from the meal and you don't get to eat that home cooked meal with your parents. So there's two
It's
sides.
after.
Yeah, let's say mid-afternoon, nowhere near a
Yeah.
meal. Let
All
just
right.
bring it out. Say, hey, I need to talk about something serious. No food around.
No food around. All right. And what's more awkward, right? Asking your parents about the will, or asking for the Wi-Fi password at the dinner party?
Dinner party is you need to keep that intimate, so maybe not then.
Right. Okay.
We'll go
All
that
right.
way.
This is good. Perfect. You nailed it. So thank you so much. All right, Chad. This has been so insightful. So thank you for bringing such clarity and heart to the topic for most people avoid until it's too late. We'll also be sharing the link to the inheritance playbook and formula wealth as well in the show notes. And to everyone who is listening in, if you haven't had the talk yet, this is your sign. So till next time, this is We're Trying to Figure Out. Thank you for joining us. And until next time, take care and keep innovating in everything that you do.
Thanks, Saul.
Cheers. Thank you.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now